Hello everybody, welcome to the Complete MBA. This video is a short introduction to accounting, which is usually the first course you do in an MBA because it sets the roots for the next ones. I'm going to try and be as concise as possible, but everything I show can be later on asked on exams, so note that and memorize that. Let's start with it. First of all, you have to learn what accounting is. Every company records all the financial transactions because investors, managers, and governments, they all use this information to make decisions. Accounting or bookkeeping tries to standardize this process of recording and showing the financial transactions. Once you know what accounting is, you need to know what an accounting cycle means. The accounting process, also called accounting cycle, consists of a series of steps that accountants do in order to record all the transactions. The main steps are 6. We're going to go one by one and explain them shortly. The first one is collect the documents. All the accountants at the beginning, they take all the documents that prove every single transaction that you did. These documents can be, for example, invoices, receipts, or other more complicated ones such as salary rosters, where you pay all your employees. Remember that accountants, what they're trying to do here is to prove that the transaction existed and the amount of the transaction was exactly as they noted. The second step is the unadjusted trial balance. Once they got all this information, accountants do what they call equalize the debits with the credits. We're going to learn what debit and what credit means in a later video, but for now you just have to understand that in this step here, they're proving that they know where the money went and where the money came from. The third step is the special entries. Sometimes what the accountants write on their database is not just a payment. For example, I paid €100 to buy a computer. Sometimes the entries they require calculations. This step takes that into account. An example of this step is, for example, the depreciation. Another example is the taxes. In both of these, the accountant needs to calculate something before putting that into the entries of the database. Those are called special entries. If you don't know how to calculate or what those means, don't worry, we're going to learn that later on the accounting course. The fourth step is the adjust trial balance. The unadjusted trial balance didn't have into account the special entries. The adjust trial balance takes into account the special entries. It's just that. The next one is the financial statements. Using the information from the adjust trial balance, this is using the information for all the transactions done in your company across the whole year, these accountants create main documents, summary documents, that explain investors and governments what the company did. To put an example, there are 3 main documents done in this step here that usually all governments require to all companies. The first one is called the balance sheet. We're going to learn about these documents later on, but for now it's interesting for you that you know how they're called. The balance sheet is just a picture of how the company is right now, the amount of assets it has, the amount of liabilities, etc. The second documents they do, it's called the income statement. The income statement is a summary of how much money the company created, taking into account the costs, the taxes it paid, etc. The third document is the cash flow statement. In the cash flow statement, the accountants summarize the cash status of the company, because companies can run out of cash, so they want to have always an eye on it. These are the three main financial statements that accountants do once the trial balance is closed. The sixth step and last one is close the books. At the end of the year, usually the calendar year, the accountants take all that information and entry all that into government's documents, into documents for investors, and summaries for managers. When this is done, they say that they have closed the books. When they close the book, accountants note that as a new financial year closed. You'll see that I call that financial year and not calendar year. This is because not always the calendar year is equal to the financial year. For example, many companies in the US close the books on October, meaning that October is the financial year end for accountants in those companies. Well, now that you understand the accounting cycle, we can go to the next one. Accounting principles. There are four main principles in accounting that you have to learn. All accountants say that every transaction you enter has to be accurate, reliable, time-bound, and relevant. What do they mean? Accurate means that every transaction you enter in your database has to have as accurate as possible. You shouldn't round up or round down any entries that you put there. 1,000, for example, isn't equal to 999 euro. This is an example an accountant wouldn't accept. Reliable. What does reliable means? Reliable principle says that all the data that comes has to be true. In order to do that, the accountants make sure that this data is correct by collecting the invoices. So having the invoices prepared means that accountants are sure that this transaction actually happened. Time-bound. Time-bound means that all transactions that you enter in your database have to have near it and associated to that a time to know when it happened. This is the reason why all the databases in accounting usually have a column saying when that transaction happened. Relevant. In relevant, we're meaning that we only note those transactions that are important for investors, governments, or managers. This meaning, for example, an accountant won't note that you bought a pen. It will just put a family of accounts and saying, for example, 1,000 pen had been bought during this calendar year. Because if you put 1,000 lines, managers are gonna, or investors or governments, are gonna lose the track of what is happening there. So these are the four main accounting principles. Let's go to the next point. Historical and fair value. You may know already this, but it's important to explain that to the people that don't know that. Historical and fair value refers to the value of an asset or a purchase. The historical, well, let's start with the fair value. The fair value, also called market value, is the value that an asset has at today's price. For example, if you bought let's say a computer 1 year ago, the historical value of that computer would be the amount of money you paid for that computer 1 year ago. Let's say 1,000 euro. The fair value of that computer is the value of that computer now in the market, because you have used that and nobody will buy it for 1,000 euro. The fair value or market value of that computer would be 900 euro, for example. This is the difference. Usually fair values or market values are lower in assets than historical values, but it can be the contrary. For example, if you have something that gains value with time, like a very old car or a very important jewel or painting, the fair value or market value may be higher than the historical value. Let's go to the next point. Accounting standards. Accountants all over the world have different standards on how to write assets or liabilities, etc. in their databases. We're going to learn two different standards: rule-based and principle-based. Let's explain here why they are different. Accountants need to put all the transactions that happen in a company in their database, but in order to do that, they have to follow a set of rules. Imagine that a computer has been bought. When the computer is bought, for example, for 1,000 euro, the accountant may ask him or herself, where should I put this computer? In office assets? Well, a computer is an office asset, but it can be also, for example, a plant asset, because it may help the production of something. So, in order for the accountant to know where to put that, different governments tell accountants different ways of choosing where it goes. Rule-based standards are accounting standards in which accountants see a well-defined rule family where explains him or her where each type of transaction should go into the financial statements. For example, if a rule-based standard would be, if the computer is more than 100 euro, then is a plant asset. If not, then is an office asset. You see that the rule-based standards, they are very clear and very easily show you where did you have to put every single thing. However, they have a negative connotation because rule-based standards tend to be very complicated and therefore they are timely consuming. They consume a lot of time. The most important rule-based standard is what we call the GAAP, which is an acronym for General Accepted Accounting Principles, and is used in the US. In the US, the accounting standards required by the government are therefore rule-based. In the principle-based, accounting is done following a set of principles that more or less leave to the accountant's judgment where each transaction should go into the financial statements. Of course, this can be more easily manipulated, but it requires less time, which is very important when you want efficiency in a company. This is the reason why most of other nations use principle-based. To follow with the example, if rule-based says you, if computer is used more than 100 euro, use it as a plant asset, if not, is an office asset. A principle-based would say, for example, if computer is mostly used for admin tasks, then is an office asset. You see that it's understandable that it's very easy to choose where it goes, but it's also very easily manipulated. The main accounting standard for principle-based is called IFRS, International Financial Reporting Standards, and is used internationally. Now that you understand the different standards, let's go and explain a little bit more about one of them, the International Accounting Standards. So, the International Accounting Standards are done by two different boards or committees or bodies. The International Accounting Standard Committee and the International Accounting Standard Board. They both create the International Accounting Standards, but the International Accounting Standard Committee was created in 1973 and created accounting standards until 2001. From 2001 to today, the International Accounting Standard Board continued creating these standards. For the International Accounting Standard Committee, all the standards that are created are called IAS, International Accounting Standards. For the International Accounting Standard Board, all the accounting standards created are called IFRS, International Financial Reporting Standards. Both of them are valid, but if there is a IFRS created that substitute an IAS, this will be the correct one. Remember that. You also should know about the basis of accounting. There are two main bases, the cash basis and the accrual basis. In the cash basis, accountants note the transaction whenever cash is exchanged. In the accrual basis, accountants note the transaction when the receipt is done. This is a main difference because receipts can be created when the cash is not yet exchanged. Let's say, for example, and to continue with the computer, that you decide to buy a computer today. You get the computer today, you get the receipt today, but your bank may pay the computer to the merchandiser per month, for example, at 100 euro. Then the accountant at the retailer where you bought the computer will note this transaction, if it's in accrual basis, the day you bought the computer, and he will note, hey, we just won a sale for a value of 1,000 euro. The cash, if he was using the cash basis, the accountant on the retailer will note 100 euro each month while your payment is done, saying, hey, we just made a sale of 100 euro. You will see that the differences are very big. In the industry, the accrual basis is the most used one because it helps you to know what is going to be the status of that company in the future, because it includes future payments. With the cash basis, you don't know if what's going to happen in the future, because the summaries the accountant created only take into account the account paid at that very moment. You should also learn about the different types of accounting that there are. There are two main types and then a family of others. The two main types are the financial accounting and the managerial accounting. In financial accounting, accountants learn how to create standardized financial statements. This is the statement I explained you before, for example, the income statement, or the balance sheet, for example. This is summaries that are going to be used in a standardized way for everybody, investors, governments, etc. In managerial accounting, however, accountants learn how to create statements, but not in a not in a general way. Managerial accounting is concentrated on what managers of each industry need. For example, accountants in an industry that creates, let's say, gas cylinders, managers of that industry, they may be interested, for example, in costs per gas of cylinder oxygen. You can see that this is very special to that kind of industry and maybe only to that kind of company. So accountants in managerial accounting try to tailor their summaries to whatever the managers want, and these tailor-made summaries, they cannot be standardized. That is the difference, standardized and not standardized. There are other accounting types that accountants may learn. For example, accountants within governments do governmental accounting, which is totally different to the accounting you will see in a company. There are other types of accountings, for example, non-profits. They have a different way of reporting profits or reporting accounting standards, etc. Now that you know about the types, let's go to the last point, which is explain very quickly some concepts, some accounting concepts. I'm doing this because I've seen that many people come into the accounting class with an idea of what some concepts mean that is wrong. Let's check the first three of them. In accounting, revenue and receipt is not the same. Revenue is something written when the sale is made. I'm going to put here a hand, with a hand, when the sale is made. Receipt is done when the cash is obtained. So when you get the euros or the dollars, that is the difference. The second one is the difference between gain and revenue. Gain is revenue coming from non-primary operations. Non-primary. This is, for example, a revenue that came, a gain or money that came because of a lawsuit. If your company is concentrated, for example, in selling pens and a lawsuit creates revenue, this comes from a non-primary operation and therefore is called gain, not revenue. In the revenue is all the earnings coming from the primary operation. For example, if your company creates bicycles, the revenue of that company would come how much money have I done selling those bicycles. The third concept is expense versus expenditure. An expense is a payment done that is necessary to maintain the revenue of a company. This is the primary operation, remember. For example, if you have maintenance on the machinery that you need in order to maintain the revenue, maintenance is usually an expense because it's something that you need in order to maintain those machines and therefore the primary operation. Expenditure is a payment done to purchase a big new asset or to expand the primary operation. So it's a purchase to expand or to reduce the debt or to new things. That is the difference between expense and expenditure. Okay, with this I would like to finish. If anyone has any questions about what we've covered in this video, then feel free to ask in the comment section below and I will do my best to answer them. If you like these tutorials, the best way to support me is to give a thumbs up and maybe subscribe. If you're doing an MBA, I've written a book with all what you need in order to pass all the exams. This is the complete theory and all the exercises. You will find this link, the link to this book, in the description below. Thanks, and that's it for today. Thanks for watching and see you in the next video. Bye bye.